First rates Monday morning, and we start with a print of green, but it's almost like a flat start with no particular bias, which frankly is great news given last week's price action. The breadth is positive. Now the first rates are just kicking in. You want to start with Bajaj Finance. Why? They've pulled another rabbit out of the hat, this time by saying that we will raise capital. And if Bajaj Capital is looking at raising capital, well, they're very mindful of return ratios and they would be cognizant of not sitting on capital, raise capital, which will damage their return ratios, which means they're looking at increasing their lending. 7,500 for Bajaj Finance, the stock is doing mighty well for itself. Now, the mid-tier names. JP Power, IFCI, you've got GMR Power, IOB, Union Bank, Central Bank of India. Well, all of them have something in common. Well, all of them are positive. You've got RVNL, you've got IRCON, you've got RNRLN. All of them are trading with a positive bias. What is moving up in terms of an absolute move? Nothing big in terms of an absolute move. Let me see if I can just see that absolute move chart. No, it's not coming up right now, but nothing in terms of an absolute move. Where you want to be a bit wary is that the tiny toons have started again, jumping very, very high. So you've got JP, Unitech. Really, the small chotu ones are the ones where the price action is picked up.
Yeah. Let's just revisit Bajaj Finance. Almost about 2% higher and still counting up. There's also strides. They've got a US FDA nod for one of the cardiac drugs. So look out for that as well. And hey, what is Religare up to after that open offer by the Berman family group? Let's check in on that stock. 6.5% lower. It's almost a 7% crack that you're seeing on Religare as we speak right now. On that note, I also want to check in on a couple of these companies which have made some small minute acquisitions. Renuka Sugars, for instance. A, that they've approved a fundraise of 285 crore rupees. B, they've acquired this company called Anamika Sugars for about 235 odd crore rupees, 2.25% higher for that stock as we speak. The other one, of course, is Delta Corp. Not to say the stock wasn't already beleaguered, but look at the whack that you're seeing on that stock after DG GST Intelligence has issued a notice to pay tax liability of a total of 16,822 crore rupees, which is, I think, higher than Delta's current market cap. And, needless to say, you would have seen that kind of a move on this particular stock price. REC has withdrawn as one of its nominees, Suzlon Energy. That's the stock that I'm talking about. Just bring that one up for you on your screens. And then ICICI Lombard, wherein Sanjeev Mantri has now been appointed as the MD and CEO. That's going to be the other stock which is going to be in focus. And then Karnataka Bank as well. And they've made a fundraise via preferential issue. That's the other stock that you may want to look out for. By the way, LIC also has received, I think, one of, a tax intimation. So maybe that stock as well is in focus this morning. What are PSBs up to? Canara Bank, BOB, SBI, they were the high flyers from Friday, right? Let's revisit some of those. I think that move has gotten corrected a little bit. Naresh, absolutely a flat start on the index. Any trades that are looking worthy to execute?
So being defensive here, GAIL India looks interesting at 120.21 with a stop loss at 117. Could be a good zone from where it does a retest is done and could be a bounce back from here.
All right, Rudra, let's get in your take as well. What is it that you're punching in as your first trade this expiry week and in today's trade?
See, for me, Bajaj Finance was looking very strong, both in terms of news as well as stock on the chart. But however, because it has moved up too much now and an entry here may not be good, I will stick to Axis Bank short call. This has been one stock which was ready for a correction, and I won't be surprised to see 990 levels to come on Axis Bank. Having seen fall in HDFC as well as ICICI, now it is the turn of Axis Bank to make that move towards 990.
Ganeshram Jairam, Managing Director and Head of Avendus Spark Institutional Equity, joins us now. Let's connect with him to understand what he makes of the current market setup. Ganesh, good morning. Thank you for joining us. We've seen a bit of a here and there kind of a move in large cap stocks. And last week's price action, if anything is to go by, was slightly damaging. What is your market assessment? Do you think we've peaked out for the year, or right now we could just see a sideways market with no big sparks?
Morning. Good speaking to you all. I think, we've been little on the cautious side on the markets. It's been a very dichotomous economic recovery. Okay. In the sense, in the last, say, 6 months, maybe even 9 months, consumption has moderated quite significantly. And that's something that we are watching. Why this kind of moderation? If you see various categories, including FMCG or QSR space or the innerwear or across apparels, even categories on auto, there is a moderation in volume growth. Okay. Pricing has been pretty okay. Price hikes were taken last year, and since then, raw material prices had eased up. So gross margins improved. And that led to kind of operating leverage play out. But volume growth is what we are watching, and that's moderating. We are keeping an eye out. Exports, okay, that's also moderated in a way, in a quite a significant way, including IT services exports. IT companies headcount has been moderating. Naukri jobs index not showing great trends now, almost 6 months. That's one side of the picture, the whole domestic consumption side of things. But that's possibly at, I'll say, almost like a lows in a decade kind of a consumption pattern. But what's at a decadal high is the whole manufacturing, industrials, capex drivers. Okay, when you look at how the capacity utilization is picking up, the balance sheets of large corporates, the capex announcements, the sanctions by banks, that's picked up very significantly in the last 6-9 months. The whole MNCs looking at India on for not only their services side, global capability centers, but also their whole manufacturing side. So very dichotomous, slowing consumption and industrials picking up, and that's something that we are penciling into our top picks and model portfolio that we are recommending to clients. This is a very important change. 2010 to 20, the drivers of the economy were demand, consumption, retail loans, whereas the last maybe 18 months or so, it's been more of the whole supply side of it. From demand to supply is the swing, more of who's creating capacities, who are the beneficiaries of that capacity, and that capacity is coming in property, it's coming in manufacturing. So the portfolios need to reckon and recognize this, and that's what we have been telling, and we continue to be more polarized in our whole stock picking and construct of our top picks.
Ganesh, I'm just, playing devil's advocate here because, and let's talk about the brightest sparks, and let's pick up on the point that you were making about CapEx. Large part of the CapEx is actually government-led. Do you not think that it's going to peak out in FY24? Because, soon we're going to be stepping into election year, and then there's always that overhang of not exceeding too much on the fisc.
No, I think you're right. Government capex will possibly peak out in current financial year, but who will take over the baton on the capex side of things will be the private sector. That's what we are working with our views on, that the private sector capex, the drivers of which are already visible, and PSU companies as well. Okay, they will also be driving capex, and they will also lead to the broader economy's drivers moving from government capex to private capex. So you're right on government capex.
Ganesh, while I'm with you when you say that the consumption patterns are slightly puffy-duffy, but if one looks at a very basic benchmark, which is that the credit growth, what banks are reporting, especially for retail credit, those numbers are looking very, very smart. So if retail credit is growing, which could be unsecured, car loans, even it could be gold loan, why are they growing then?
That's the dichotomy. That's the million-dollar question. Are this kind of weakening consumption and rising personal loans are itself a concern? Okay, where is the money going? Is it being used to fund debt servicing? Okay, because unsecured loans are growing at almost 30%. So we are asking some fundamental questions on why this dichotomy between consumption and the credit growth. About maybe 20 to 25% of credit growth is going into the travel tourism angle, where we are seeing very good trends. You see the hotel rates, you see the the flights or the occupancy levels there. That's showing very good trajectory, but that can't answer this kind of growth in absolute terms. So very critical question on this dichotomy between credit growth in the retail loans and the weakening consumption side of things, especially mass consumption.
So, Ganeshram, to the point that you were making about private capex actually taking on when the government starts to ease off, who's going to stand to be the beneficiary? Because what we've seen is that the beneficiaries of the government capex have been very new themes, right? Your railways, defense, a lot of infrastructure as well. But what about private capex?
Very different names. Okay, it will be more of capital goods companies, equipments. It will be, this nature of capex is also very MNCs driven. Okay, and that means a lot of there will be quality names and not unknown companies which will be deriving demand out of this. So obviously, we are looking at various capital goods companies or companies more in captive power, or it could be in water treatment, environment treatment, sewage treatment, or so the nature of industrials preference is also shifting for us from government spend beneficiaries towards private capex beneficiaries, and the names are quite different too.
Morning, I wanted to also get in your stance as to what the outlook in this kind of environment, with the fact that we're seeing high food prices, the currency as well coming under pressure, what this could force the Reserve Bank to do in the monetary policy?
If not for the inclusion of the bond index last week, we would have been more wary on the macro with oil at 95 odd. Given how the exports are behaving, this too would have meant that the current account deficit, which will still maybe double up in the second half vis-a-vis first half, and invariably that puts pressure on portfolio flows. Okay, and this would have played out, and if not for the bond inclusion, wherein due to that, of course, it won't come in the second half, it will come in June onwards, but markets will start expecting it, price it in. So and that's why the behavior of the bond markets, behavior of the whole call money, overnight markets, the whole interest rate side of things, the whole how RBI will work towards it, those could get a little better. And that will actually ease up some of the macro concerns which were building up over the past month. And that's why market has been a little iffy in that sense. And globally, also we will possibly we're getting into a kind of an air pocket on growth as well. So those concerns on that remain. At the margin, the whole bond inclusion news is, in my view, a very important positive, getting into how we can absorb the oil shock if it continues over the next 12 months.
Your model portfolio, which you recommend to your clients, is talking about raising cash about 10%. That means you, in general, are struggling to find value anywhere.
That's true. I think, if IT and overall exports are slowing and consumption is moderating, given the valuations in the consumer side of things, we need to be a little more towards margin of safety. We're looking at managements who have a track record of performing not just when things are good, when there are tailwinds, but across cycles, right? You need to see the behavioral pattern on how they gain market share, how they create new opportunities. And so it's a very specific stock picking approach and not a more wider distribution that we are recommending. But some of them are expensive. So we think, this approach of margin of safety needs us to keep higher levels of recommend clients to have higher levels of cash than normally they would have had. Of course, the confidence on capex is there, but how much proportion you keep there. Fourth is what we have recommended. That itself is much higher than the overall weights for the respective sectors. But rest of them, we need to be a little watchful, need better prices to deploy those cash.
When you say manufacturing is at a decadal high, could it be a multi-year trend where historically, I just want to bring this out for our viewers here, Ganesh, that when a big sector starts, the P multiples will always look out of whack because the sector growth will always surprise us. And if you look at IT or for that matter, fintech, or a lot of companies, when they started a multi-year curve, at the beginning of them, the valuations were not 5-6 P multiples, they were always high. So could that be the story also for manufacturing, that yes, these stocks are up 50%, 100%, 150% from the recent lows, but if one is looking at terms of trends, this just could be beginning?
We believe so. In fact, asset turns of those companies are still quite low. Even operating margins are below, and those industries have consolidated. So if you take, let's take a case like say construction, right? How many construction companies are today left with to execute large projects? You know, these 3,000, 5,000 crore projects, they're hardly maybe one or two. A decade back, they were say maybe 10 companies. Okay, so that means better pricing, likely better terms of trade on working capital or repayment terms. So valuations, even though they appear a little expensive than their long-term average, we are not faced by that. We are more comfortable recommending clients to pay higher multiples for either comfort in management quality or comfort in earnings growth quality, and not just growth, but also on the quality.
With something which in a sense resonates just with our viewers, that when you say comfort and good quality or management and good quality at reasonable price, what qualifies that cut?
So it's about the balance sheet quality. It's about the track record of managements who have performed well, how their market shares have evolved, even though in the down cycle, how they protected balance sheet quality, how they looked at market share vis-a-vis the peers who gained them. And that's what we are looking more towards, how the technology is better today to meet the kind of capex which is being presented, largely MNC-led capex, how they are positioned to take that potential. Those are the things that we are watching.
All right, appreciate your time. Thank you so much for joining in and giving us a sense as to what the outlook is when it comes to individual sectors, the capex cycle, as well as what the Reserve Bank could potentially do. A quick check-in as to what the market is up to then, and at the current juncture, we're circling around the 19,650 mark in trade. It's absolutely lackluster as well when it comes to the broader universe. So for now, continues to remain rather quiet in trade. But Nikunj, spotlight is as well on the JSW Infra IPO that's going to hit D Street, the first company from the JSW group to launch an IPO in the last 13 years.
Yeah, you know, normally from the house of Tata, from the house of Reliance, from the house of JSW Group, you don't see too many companies. Not that they have too many companies which they want to list. But, you know, it's an interesting company because the port business in India will grow in and around the GDP growth. It's a business which perhaps has not too many, buyers. It's a business which in a sense up until now was getting a large amount of support because of the expansion of JSW Group, but now is looking at also expanding. So if you're looking at India being this being the decade of manufacturing in India and this being the decade of India, put two and two together, India would be at the center in terms of pivoting. And when you are pivoting from, let's say, a software service dominated economy to a manufacturing dominated economy, the inclusion of port, I think, would be will only increase dramatically. Now, whether it is coal handling or exports out, I think this strategic location of some of these ports are almost like ecosystems which have got created. So it's a high growth business. It's a business where you know that if there's a company coming from JSW Group which has a track record of creating phenomenal amount of value for shareholders, I think is to be believed, then this would be one of those long haul stocks where you want to invest in. Now the tricky part is, Avan, these days, you have IPO listing which happens in less than a week now. So there is no market risk which is associated with this, but if the market conditions are not that stable for next couple of days, which is what they are not, you may not be in for a gangbuster listing. But if you are looking at for the long haul, let's say you say that I'm betting on India, within that I'm betting on ports, and within that I'm betting on JSW Group, then it just becomes one of those stocks you just want to buy and put it in your portfolio and don't discuss it on a daily basis. For me, this kind of a business demands that kind of an attention without getting into, okay, what will happen after 1 week when the listing will go through. These are businesses which have a cyclicality to it, but they also have a long-term growth highway, which is where things are. I mean, just think about it, right? You are a country which was dominated by domestic consumption and IT exports. In IT exports, you don't need a port. You don't need a port, right? Yeah. But if you're pivoting to manufacturing, so your internal demand and external demand, they both will actually be centralized around the port now. And not too many players are there in the port.
Yeah, I mean, their closest competitor is only Adani Ports.
Adani, Jain, PT, but that's a completely different kettle of fish. Yeah. So, very finely run business with fine professionals. I'm coming from a group which has got a track record of creating wealth. So like they say, when you always look at you use the word pedigree. Yeah. I guess in this word, the pedigree and the lineage, I think they both are very favorable.
And much can be, or rather the same can be said about, I think, Bajaj Finance as well. The stock is now up 3.5%.
So Aisha, they've surprised and they've delighted everybody. And Bajaj Finance is one company which in a sense has defeated a very simple law of economics that large numbers base effect would kick in. So at that base, if they're growing at 30% and they are preempting a capital raise or preponing a capital raise, with the current ratios, they could have easily delayed it. It clearly means that in the near term, they are looking at changing the growth orbit. If you're looking at changing the growth orbit, which means the growth will be higher than what it has been in last couple of quarters. And if that happens at very high return ratios and when valuations at a multi-year low, I beg your pardon, then that automatically re-rates the stock. So valuations are low, price to book will go higher, growth will go higher. This is not capital which is required to fix the balance sheet or fix the damage which has happened. This is pure growth capital. So in Mumbai terminology, if you are in Mumbai road in fourth gear, which is 50 to 60, it's a reasonable and respectable speed. That is what Bajaj Finance.
It's a great speed if you get to go on fourth gear in
right?
Mumbai
So that's what Bajaj Finance is doing. It's a great speed at they're growing. Yeah. But in Mumbai road, if you go in the sixth gear, you would say, oh my God, am I lucky? Or I'm doing something which is different. So I think this is that OMG moment for Bajaj Finance that in a Mumbai road, you are going from fourth gear to sixth gear.
At cheap valuation.
At cheap valuation.
Yeah.
And the market is clearly cheering that.
Absolutely. Along with that, by the way, there's Bajaj Finserv also, which is scaling higher. Typically, these stocks move hand in hand, 2.5% higher on that too. Some of the other movers, and I must mark those too. Look at IRCTC, that's up 2.5% right now. There's also Balrampur Chini, there's Ramco Cement. These are all stocks which are looking good, but Delta Corp locked down in 10% lower circuit. Another fundraise of 1,500 crore rupees from Karnataka Bank. So let's welcome on board Sri Krishnan H, the MD and CEO at Karnataka Bank, joining in on the show right now. Mr. Krishnan, great to have you on the show. Congratulations, firstly, on a healthy fundraise. But you still have a window for another 700 crore rupees because all you've done is 800 so far. Tell us about where capital adequacy stands and how is it that one should look at it going forward.
Thank you for the compliments on the fundraise. Essentially, as a bank, we do have a 3-year outlook in terms of the plan and the growth. As we have already given the guidance on the asset book, we would be growing in and around about 17 to 18%. So every 10,000 crores of asset that grows, we need about 1,000 crore of capital. So obviously, we need to fund for that. The second is that we have an enabling resolution right now for 1,500 crores, out of which 800 has been already allotted by way of preference allotments to very marquee investors. And these are all long-term, deep-pocketed investors who would stay with the bank. And it actually helps us in broad-basing our overall cap table with more institutional names. As far as the capital adequacy is concerned, we are comfortable right now. And it has been a guidance that, including our tier 2, we would always stay upwards of 17%. And this is going to continue. But as I said, that asset growth and anything that we require in terms of stability requires capital, and which is why we are raising this. And there will be a follow-up round also. The second part to this is that we do have tier 2, where it is expensive, it is at 12%. And there is a callable option for us in November and in February. So if all is well, we might even exercise that option and do the follow-up round, which in any case is enabled as per the resolution passed by the board of directors yesterday. So that kind of gives you a sense on what the plans are and how it will shape up.
Option for tier 2 capital in November and in Feb. Now, is this independent of the fundraise?
No, the existing tier 2, there are calls that the bank can exercise as per the fundraise that happened several years ago, and that is due for the call option in November and in February. So that is independent of this fundraise. The second is that utilization of the proceeds of this fundraise will go towards growth capital and growing the book and also the infrastructure investment that are required in technology and products and people. So what we have enabled is that a total fundraise of about 1,500 crores, out of which 800 has been announced yet. And we actually will have a balance of 700 crores, which we will raise as a follow-up round. It could happen in the second half of this financial year.
Right, and I wanted to follow up on that. Is it going to be new investors or is it going to be existing investors?
Well, we will have to look at the market at that point of time, and we have enabled all kinds of instruments, which include pref allotments or QIP or rights issue. So all of whatever instruments are permitted for the capital raise has already been approved.
Right. So was there larger interest in the current round from other investors as well? And what do the current investors bring to the table?
Well, yes, the interest levels are high from institutions. They are seeing transformation agenda being executed by the new management in Karnataka Bank. So obviously, transformation doesn't happen overnight. It takes a couple of quarters and a couple of years. So they are seeing that we are on the right trajectory, and that is how the interest has been, and which is how it has been reflected in the trading volumes also. Having said that, in this round, we have limited to certain names. And yes, we did have interest much more than this. But we'll definitely consider those names in the round 2, which is bound to happen by the end of this financial year.
And what about the loan growth? You suggested last we spoke that you were calibrating loan growth guidance. It continues at 13%, or would you be looking at changing it given that the market growth has sustained?
So we will grow with the market for sure. The market has been projected to grow at 17 to 18%. So while our growth will remain at about 13 to 15%, but with the capital in place, we believe that we have the right kind of strengths to grow this aggressively. But we will not compromise on quality. We will also make sure that the rest of the metrics related to NIM as well as our overall cost of funding is something that we will take care of. So we will do this on a very calibrated basis, but continue to grow for sure. And that is the agenda right now.
And on your tier 2 capital, you had also suggested a 12% coupons. How are you looking at the cost of funds? Any impact, you think, on the Indian bonds being included in the JP Morgan bond index?
So the interest rate cycle is something that has already peaked, and that is our view. And I think the first quarter of next year, we would see this, being very steady, if not rising. Now that gives us a lot of opportunity because one, the debt market, which has not been that developed with this inclusion by JP Morgan, certainly has provided a lot of openings for all players. Secondly, we are again dependent on the rating that we get post our couple of quarters, and also making sure that if the interest rate cycle is favorable, we would go in for a tier 2. And this is something that we have already got an enabling approval in the last AGM itself. So we will be essentially looking at a mix of both tier 1 and tier 2 as we go along to make sure that it is like rightly funded for the growth of the bank. And obviously the current rates at which tier 2 has been raised are expensive, which is why we are looking at a retiring option there.
Sure. Your deposit growth challenges on ground, they clearly continue. Is that a concern for you?
So stickiness as far as the liabilities is concerned, Karnataka Bank has had a history where a lot of our liability customers do kind of maintain sufficient, liquid funds. The second part is that traditionally Q3 has always been good for the bank because a lot of this agri customers post their harvest season bring back the funds into the bank. And that also has a very, very clear bearing on the CASA. But CASA right now we are at about 33%, which is quite healthy and will continue to be so. So we do have a lot of stickiness in deposits. On the growth part related to deposit, it is not growing as in the industry as the asset side of the book. Having said that, we are comfortable right now because our CD ratio has been only 70%. So which means that, we do have headroom for growing the asset book without having to really get worried about the liability side. But yes, we need to chase both sides of the balance sheet.
All right, good to have you on board. Thanks so much for joining in and giving us a sense as to what the fundraise was all about, as well as what the outlook is in terms of your growth projections. That's Karnataka Bank at about 245. Quick break right here on the show. Be right back as we get you more corporate voices and market news.
Manish Dangi joins us now. I always look forward to our engaging conversations, and every time off the record when I meet him, I like to call him the Guruji of macro world. So Guruji's come back from a short travel, right?
That's true. Hi, good morning.
So what is your view of the world? I mean, Fed has changed their view of US economy. Who would have thought at the beginning of the year when we were discussing and debating soft landing, shallow recession, Fed will come out in the middle of the year, they will upgrade their GDP outlook. What are the implications of that for all of us?
I think it's a bit of a noise there, but in general, we're nearing an end of a rate hike game, Nikunj. Perhaps it's the last lap, not just in US, but pretty much across the world. US economy, we've argued about it many times that it's holding up well, but that does not equate with buoyant growth. It's a decent growth, slowing, and in an ecosystem where countries like Europe, both France, Germany are contracting likely now. China is into structural struggle. So the general setup is that global growth continues to slow. It has surprised many strategists and fund managers that the growth hasn't slowed as much as they anticipated a year ago. But then it still means that at some point in time in the next 3-6 months, they're going to be decent pain given what the central bankers have done. So I continue to believe that Fed is likely done now. And the only difference between likely done with vis-a-vis the general reflex that we tended to have in the past is that a little bit of a soft patch and our Fed would actually chop rates. That's not likely to happen, and which is what is unnerving market to a certain extent, both bonds and equities.
Okay. The other big announcement which came on Friday, which will have deep ramifications, would be India's inclusion by JP Morgan. What implications would that be? I mean, we celebrated the inclusion on Friday in financial markets, calling it like an early Diwali and something which will have transformational changes. Is it true in your understanding?
No, I don't agree with that. It's basically a currency hedge that RBI has bought for two reasons. One, of course, Nikunj, is that the traditional sources of capital flows in India have actually been drying up. If you observe the facts keenly instead of narrative, the ECB has stopped trickling in the manner it used to. FI debt for last 6 years, there's been a winter there and money hasn't come on its own. FI equities, of course, notwithstanding the good time we've had over the last few months, 6-8 months, as a matter of fact, over the last 7-8 years, it isn't a durable money anymore. So in that setup, even things like FDI, again, contrary to popular narratives, is not as meaningful as it could be, and it's not rising anymore. Again, because of the global setups, we've discussed about these things many times. But then our need for dollar has been rising every year. We need $60-70 billion to fund our current account deficit. So as traditional means dry up, you ought to look for something. Otherwise, you end up doing things like FCNR and stuff like that in every crisis. So, it's a good way. There was an orthodoxy in Delhi and in RBI that we should not expose our bond markets to the outside world. But if you need dollars, you ought to do something. So it's, in some sense, it's buying of a little bit of insurance. Its impact on currency volatility would be less, but then impact on rates and equity markets is minimal or negligible. Especially for rates, I've argued about it many times that it simply displaces more programmable, more authentic, and counter-cyclical source of money like OMOs by relatively more volatile and speculative money of FI and stuff like that. So to that extent, it may end up making markets more volatile, and on net rate move basis is not substantial, Nikunj. So that's the way I look at it. But it's a welcome move. It's been something that has bond market practitioners we've been waiting for at least 10 years. So I think it's a good idea to expose our markets, and to enrich market. What has happened in equity over the last 25 years, perhaps if we open it up to the rest of the world, there is going to be more volatility, good news for many traders, and therefore, it's exactly a thing that, all bond market veterans have been wanting, but then its net effect is not as much as, as being sort of argued about in media.
What about equity investors, though, Manish? How should they be building the blocks right now? Because while the equity markets on an index level sure are off about 2.5-3% from the recent peak, we're not that cheap either.
So on equities, Aisha, the building blocks are, of course, very simply put, rate architecture and growth outcome. And on rates, as I've argued, that it is very likely that, we are coming to the top of interest rates. But unfortunately, even if there is significant disinflation, the real rate would actually continue to stay up. And to that extent, the struggle on the rate front could actually continue. But it's not going to worsen in any significant manner from here on. On valuations, pretty much across the world, equity markets are saying that either we are starting with a new business cycle right now because there is anticipation of significant earnings growth pretty much across the world, even now, or they're saying that bond markets are completely wrong and Fed would and RBI would and many other countries would actually ease very, very sharply in 2024-25, which bond markets are not agreeing with. So the equity macro is in contrast to what currency macro and rates macro is, and to that extent, it's not going to be easy deal. Valuations, of course, continue to remain expensive. In fact, in US also, we argued about 1.5 months back on your channel that there's no great play in US as well because especially tech has become pretty expensive in the setup that we live in. So on average, if I were to think of India, Aisha, then, large caps have become have become cheaper relative to small and mid caps, which are in manic mode right now. And India is no more expensive relative to US. So purely relative investors, you could continue with large cap. But if you're looking for a risk premium relative to bonds, the problem is that if you pay 10, 15, 20% excess valuation, Aisha, then 3-4 years the excess returns over bonds don't come, and that's what has happened in last 2 years. Despite such strong flows, actually the risk premiums or excess returns over bonds haven't arrived for investors because you paid into mid 2021 or end 2021 higher than what you should have paid. Unfortunately, that ill has not gotten away yet.
Manish, morning. What is the outlook when it comes to the overall earnings growth? Because the expectation is that it could be at about 10%, equal to what we've seen in the last 10 years versus 15% is what we've witnessed in the last 5.
Yeah. So our argument has been same that the nominal GDP and earning growth have diverged over the last 5 years. They typically converge over a long period, as it happened in last 10 years. I am more of the view that over the next 5-10 years, the earning growth would be more like 10%, and markets are baking in, I think, faster. At least for next 2 years, the market's anticipating about 15% growth. I think as of right now, not many downgrades have happened in India yet, but I think that for the given macro where crude is, where general growth buoyancy, which is starting to peter down, my sense is that there is a decent chance of earning downgrade. So, and it's very, very unlikely that nominal growth would be any more than 10% over next 2 years. So sort of expectation is a little bit of a wrong footing. Of course, we've had great 2020. Last 2 years have been really great, especially 2022 was great. And to that extent, it may have put in some bias, but my sense is that there is the expectation of 15% CAGR over the next 2-3 years is a bit of a stretch. It's going to be more like 10-12%.
So, Manish, for the short term, what is a good trade, which is 3 to 6 months? 1 year plays, what is a good trade? And for 3 year plus, what is a good trade now?
Okay. So, I don't think it sort of suits most audience of yours. I think that because the stuff that I do, not many would do. But I think the cheapest asset in the world today is US dollar cash. It's earning you 5.5%. And it has great momentum to it. And it will preserve and protect you from any ill world economy. If economies spew flows reverse, dollar would actually continue to do well. So I think it's a good place. It's a bit of a like 2022 setup, and that's where you must hide. If from a speculator, I think for medium term, which is 1 to 2 years, I think you're going to make a lot of money in buying long US treasuries, which are at absolutely phenomenal level. I don't agree with high for long. It is true that for reshoring and many other reasons, including crude, interest rates will not go back to zero, but then does not mean that the cycle will not turn. And these rates are high enough for us as speculators to dial and actually hope for good 2%, 2.5% rally from here. So I think from a speculator point of view, for 1-2 years, there is a merit in actually buying into long bonds. Not Indian bonds yet, because India has a little bit of other complexity. The local reasons, Nikunj, of inflation have returned, and therefore we must wait for long India bonds. But US bonds look attractive at this point in time.
Request you to stay on with us. We just have a quick breather, and we'll be right back. Manish in conversation.
In conversation with Manish Jangir, trying to understand the macro and the micros of the market, and also the importance of risk management in this kind of a market. So Manish, in the way you invest and the way you allocate capital, how much importance would you give to election cycles? There are state election cycles followed by central election cycle, and everything will happen in next 12 months, less than 12 months actually.
So in election primarily have two implications, one on inflation and other is risk appetite. I don't think governments in India matter much in terms of growth, though and I think the general impact of government is overrated on growth prospects. But on inflation, there are clear ideological differences between two sides. And two sides is not necessarily two political parties. It's generally to do with how general household is experiencing or behaving right now. It increasingly is apparent, Nikunj, that every political party is now out there to distribute cash and largesse, essentially because the median household in India is in pain right now. So it's a political response to an economic problem that India or Indian consumer faces. That it has implications on inflation. If you see coal-bound states, think of Rajasthan, inflation there at 10%. I would say that as nation gets into this, election mode, more and more such distribution, cash transfers, and many such things would be announced or executed. And that would mean that at least in near term, for 6-12 months, you'll have issues with respect to inflation. That's the inflation part. Second is on the flows. I think if there were to be 1 in 4 chance, which I assign that it is, that there is a change of guard in India in 2024, it is likely that the thing that markets rejoiced a lot, which is corporate tax cut, or in general, things like PLI, which are quite suitable to large corporate, there is a risk to all of these. I'm not very sure whether they'll be reversed because India policy reversals do not happen. Reversals don't happen as much. But then one ought to be careful. Fiscal is super tight, and if you have to fund a lot of these announced schemes, which are happening in states and they are struggling with it, I think it is likely that corporate tax cuts have some risk. Not necessarily in terms of pure reversal, but there will be more cess and stuff like that, which firms don't like and won't like. So I think and that flows would begin to anticipate at some point in time and will begin to dry up both local as well as more importantly global flows.
Right. Manish, always a pleasure to have you in DT Now. Thank you for joining us, and so nice to discuss the whole host of macro and micros in terms of understanding. Before I go to Mr. Dahiya, I just want to mark the markets right now. And what do we have on the markets? It's not a bad market. It's quite steady, quite decent in terms of where the breadth is, and things are looking stable. Now remember, the handover from US markets last couple of days have been slightly puffy-duffy. When the narrative of the world at the beginning of the year was, US will slip, China will recover. Now the reality of the world 10 months, 3 quarters into this year, calendar year is, US has not fallen and China is yet to recover. So the macro positioning, risk appetite, flows, all those, they keep on changing. Another narrative which has changed from the beginning of the year is that's a very clear narrative, which is that beginning of the year was excruciating selling and pain in some of the consumer tech and fintech stocks. But now there is a revival, there is a belief, and there is an excitement given how the earnings projections are moving for most of the consumer tech and fintech stock. And one such company which has made a grand comeback, I think, is PB Fintech. Yashish and we've been interacting on this channel, on this various forum. And I distinctly remember the last time when we met was class of 21. And it was such a show which set the tone for all of us in terms of understanding of where the business models are moving. So Mr. Dahiya, good morning. Thank you for joining us. When we spoke to you last, at least that's the conversation you and me had, your guidance was 1,000 crore of PAT by FY27. But between that and now, the world has changed. Business has become better. Competition has got diluted. And interest from stock market has made a roaring comeback. So can I say that it is time for you now to revisit your guidance and perhaps make FY27 as 26? It's a reasonable question.
First of all, thank you very much for having me here, Nikunj. It's always a pleasure speaking with you. My guidance has not changed. It had not changed then. It has not changed now. If you had asked me on the day of IPO, it was the same guidance. And even today, it's the same guidance. And I don't think anything has changed at our company. Yes, we might have, this year we might be performing a little better than expected. But I think that's not anything significant, right? It's just maybe 5-10% better than expected. So I think our guidance stays the same. Just to give your viewers, because everybody would not be as clued on as you are on this. See, this year we will broadly be PAT positive. And every year in our core business, we add about 200 crores of incremental profit. And this comes from both Policybazaar and Paisabazaar together. And so over 3 years, between 24 to 27, you would add about 600 crores of positivity. And there's some positive upside here possible because in the later years, the renewals become a very large chunk. The second part is we, even this year, will be spending about 170 crores on new initiatives as a loss. And we expect by 27 to make that zero. So you should see a delta of about 760 crores from this. And the last part is, while this year our EBITDA and our or adjusted EBITDA and our PAT numbers are going to be very similar, by the year 27, our PAT will actually be 250 crores more than our adjusted EBITDA. Simply because the differential between interest income and ESOP charges. See, our ESOP charges this year are 350 crores. Last year was 650 crores. But by the 27 year, they will be less than 100 crores. So you see a 250 crore delta right there. Plus our cash reserves are growing. Even this year, we are adding about 400 crores of cash. We have the same amount of cash as we had on the day of the IPO. So I think because nothing has changed. It is just, what we said, just turning out to be real. That's all.
What has changed from a market curiosity standpoint is the birth of geo services and the fact that they're looking at scaling it up. They're looking at a lot of tie-ups, at least on the distribution side. And they've started with BlackRock. We understand that they could be changing the way the insurance distribution is done. Is that a welcome competition or something which you need to be cognizant of?
I think everything is a welcome competition. Please appreciate what we do is very specific. We cater the 86% of the value, the way I calculate the value, which is NPV of the company, comes from two single products, which are basically protection, health insurance, term insurance, right? So for us, those are extremely critical. And those products, whoever has to do them, whether it is X, Y, Z, has to do it with a lot of passion and a lot of effort. And it will not happen easily because customers don't stand in a queue to buy these products. Usually what you need is you need a lot of convincing people and a lot of hand-holding during the claims process, because these are mostly painful products. In both of them, you pay money to never see that money again and hope you never interact with the product ever. Because either you would have to die or be in a hospital to interact with that product. It's not a happy experience. It's a very sad experience. Not many brands would like to get involved in that. And it's not a very profitable business at the end of it. Please, let's appreciate a very simple thing. I think people get carried away. When you sell a term insurance, a 1 crore term insurance, 15,000 rupees, you make about 4,500 rupees, right? As a distributor, as whatever, whether it's marketing, whatever. When you sell a 3 lakh rupee loan, you make 9,000 rupees. Now, which is easier, selling a 1 crore rupee term insurance or selling a 3 lakh rupee loan? When you sell a credit card, you make 2,500 rupees. I'm just trying to explain to you. People think insurance is very profitable. It is not necessarily so. You can do much, much better in lending. Unless you have the deep passion to solve for the middle class, for the health insurance and life insurance, this is not a business worth going. It's not a business which is going to take anybody to Mars or whatever.
Fair point taken. Yashish, the other thing is, everyone in the market is now talking about Bima Sugam and as to how this could really be a UPI moment for the insurance sector. How would life change for you?
See, we get put on a very uncomfortable spot here, and I'll explain why. See, it's a regulator-sponsored project, right? And we are a regulated entity. For us to have anything but a positive comment on it is sort of suicide. So I think very difficult, but I think I'll still take a stab at it. See, UPI was a great platform which enabled payments across banks, across people, and that's helped a lot. But at the end of it, it still took a Paytm, a PhonePe, and a Google Pay to make UPI very popular. And I think in the same breath, what I would say or suggest is that as long as the platform stayed a service platform, solving for claims, see, what are the biggest issues our customers face today? Claims not getting settled or pain in customer servicing. If that part is what is focused on, it would be fantastic. If sales is focused on, I think we already have 3 million agents and banks and insurance companies and people like us trying to sell. It is perfectly fine, but I don't know how efficient an effort it is to get into sales. I think any form of differential licensing would be a very serious issue. Differential licensing means I can do X, but others cannot do it. Then that then just means then might as well not give others a license, I would say, right? But I think I've said more than I should usually say, because I do recognize that we are a regulated entity, and it's a very difficult position to be in. And I think people should be fairly cognizant and respectful of our position as a regulated entity.
There is one clarity which perhaps everybody wants to understand, that when will the entire ESOP charge finish completely, and in their whole talent hiring sequence, what kind of future ESOP policy are you likely to follow?
So we have already indicated that. In fact, yesterday or day before, we had our board meeting. And what we have done is we have moved our future ESOPs, all our future ESOPs, to market-linked ESOPs rather than discounted price ESOPs. So that tells you how we think about the future. We will not have ESOPs which are given out at 2 rupees or 10 rupees or whatever. They will actually be at market price, and management will be rewarded for taking the price upwards from then onwards. What happened in the past and what was rewarded in the past is a thing of the past and will over time keep coming down. I think we started off with roughly 600, 700 crores per year cost. It will settle down at about 100 to 150 crores. It will come down to about 100 crores to begin with. And then I think our management cost from an ongoing basis should be about 100 to 150 crores a year.
Mr. Daya, I always wanted to, perhaps understand from you that this entire, in retail, we call something as omni-channel, which is that you have online and offline presence. In insurance, what is a good model? I mean, will it be digital service by a physical model, or your distribution model will be where you need on-feed agents which are serviced by in physical infrastructure?
I think, in insurance, there are a lot of struggle points. The struggle points are at the point of claims and at the point of customer servicing. When the person buys a policy, how quickly can he cancel it? How quickly can he get his refunds? When the policy ends, how quickly does he get the money? How effortlessly does he get the money? How easily is the claim process managed? You are hearing a lot of noise around the claims experience of consumers, right? Now, those things impact the confidence of consumers. And thus the consumer says, okay, who do I trust in this whole situation? And I think for that, to some extent, physical presence becomes helpful, which is why we have deployed it in more than 150 cities now. So I think it's an interesting place, but I think the problem we really need to solve is that. One more thing I would mention to you. In the last 15 years, whenever we have had a chance with every insurance company, and every insurance company knows this, when they have two products, one is a zero commission product and one is a commissionable product, we have always preferred the zero commission product, always. And that is without exception. Because please appreciate, in insurance, you don't make money just for commission. There is marketing, there is outsourcing, there are many ways in which you make money. There is consulting services, there are many ways in which you make money. Commission is just one of those ways. And even zero commission products have charges, whether it is a marketing cost, whether it is a call center cost. So all I'm saying is insurance has not reached a stage where people are lining up to buy it and just need an app where they can interact with it. And thus, the physical support and the physical push is still required. And whether it is through a contact center, a video call, or whichever mechanism. And it's not just to sell, it is also to impart confidence that at the point of claim, that increasingly I'm hearing that when you buy from Policy Bazaar, I hear it from the consumers increasingly, that when you buy it from Policy Bazaar, more often than not, you are likely to have a better claims experience because they are getting involved in the claims experience and they are there at the point of claim. So I think that is what is required here. At the end of it, automation will become a reality. But before automation happens, the operational support is required.
Hygiene question, you've denied it though, but I want to understand this again. The buzz of PB FinTech moving into the manufacturing space. You've gone to the exchanges, you've said, no, we're not doing that. So will it remain like a no, that you will not move into manufacturing at all?
I think manufacturing needs to be defined very clearly for us to answer that question very clearly. And Nikunj, with you, I don't have any difficulty answering any question whatsoever. We're not shy of answering anything, right? Unless it's misunderstood by people. We are crystal clear. We do not want to become an insurance company, which means we have 50, 60 insurance companies in the market. Most of them are our partners. We do not want to become a competitor to them. That is not our intention, not today, not ever, right? What we do want to do is enable them. Enable as many of our partners, whichever way we can, as a distributor, as a product data provider, as a product initiator. We have a lot of product ideas. We want to help in that. And we believe some of our partners face difficulty in terms of reinsurance pricing. And thus we want to also assist them on the reinsurance pricing side, because we do have enough data which implies that we believe that we can deserve better pricing than exists in the market today. And for that, we would like to become, let's say, a reinsurance broker. Now, that is actually the end of it. Because what we eventually want to be is a reinsurance broker. Now, for that, you may for a while have to be a reinsurance carrier. Now, that is not a board decided thing, but I'm just speaking, plainly. At this point, we've not even gone to the board. And we, may have to show a bit of capital in that. However, our intention is not to become a reinsurer and become a very capital intensive business where we invest a lot of capital, and that's not our intent. Our intent is to be an enabler, be the data provider, be the tech provider, be the process provider, be the process definer, be all of those things, but not be a competitor, but be a supporter to all our partners and allow better and better products and better underwriting to happen in the market. I think the intent is crystal clear: to be a broker, whether as the broker is just a word, right? It's an enabler, whether it's at a distribution end, whether it's at a reinsurance end, but essentially be an enabler. And if for that enablement, if we have to deploy some capital, we are very happy to do so. We have capital at the end of it. But the idea is not to become a capital intensive business.
Such a pleasure having you on the show, and we must say that Nikunj and I were just discussing that you're one of the most candid speakers we have.
Thank you so much. I really appreciate being here with you. Thank you.
Okay, great. That's the word coming in from PB FinTech right now. Let's just bring up what the stock price is up to. Currently absolutely flat, but yeah, Yashish says that the value should be much higher than where the stock is currently.
See, Aisha, there are some fundamental facts which you have to understand about India. Number one is that our internet is fully penetrated, but our insurance is not penetrated.
Yeah.
Our motorcycles are penetrated, but our SUVs are not penetrated. Similarly, when it comes to insurance, insurance is not a very profitable business, but it's a business which hinges a lot on distribution. There used to be this uncle who would be an LIC agent in a childhood we used to hear, versus now you get a SMS where you can go and buy insurance policy. So a lot has changed in terms of how you distribute it. But when it ultimately comes to claim settlement is not as easy as what anybody may claim it. And this is where the role of the intermediary whom you're buying from, I think, will play a very large role. I mean, there are times when you take and I'm speaking like a customer here, all of us have had issues when we've got claims and the claims have to be resubmitted, and then the entire process which starts. That's the time the distributor or the manufacturer or the person through whom you're buying the policy plays a very large role. Can Policy Bazaar be that guy that, okay, you buy the policy from me, I will give you better.
And I will help you claim it as well.
So that's what Yashish is saying, that is what we are trying to preempt. Can Reliance Jio do that? They well can do that, but can they do that at scale and size is something which needs to be understood. You know, that many people you can service. You can't service like some 10 million people. So that requires infrastructure. Will they invest in this kind of an infrastructure, or will they move towards the manufacturing side? The tie-up with BlackRock seems to be indicating that they're more tilted towards manufacturing rather than distribution.
Yeah, seems to be the case. Okay, that's that on, of course, where we see the insurance sector headed. Look out for Bajaj Finance. It's now an uptick of 4%. Delta Corp has had a block deal. The stock has slid 19.5% now. And I think it was a sizable block deal. 3.25% equity has already changed hands. Balram Puccini, that's the sweetest one of the lot, 5.6% higher as we speak. Quick break. Be right back for more.